The team and I met with Carmela and AJ, I guess about a month ago now, and they were laying out like the rules for repaying student loans. And kind of like filing taxes, right? You want to do it legally, but you got to know the rules on how to file your taxes. And man, at 51, if I could go back to 21 and know the rules of filing taxes, about how to keep more of my money instead of giving it to the government, I would be in a whole different financial position right now. I'm not in a bad financial position because I did a great job working hard. I did a great job saving my money. I just didn't know the ins and outs of filing taxes and where to put your money and how to accelerate it and how to make the most of what you're saving. And so when Carmela shared us this piece, student loans is, I don't know where it stands in the line. Tom Hanf probably knows it, but where does it stand in the line of loan denials? Right? Like that people can't buy houses because of their student loan repayments. And so if you can't own a home, how do you build wealth? Right? Because most people build their wealth through owning a home, through appreciation, through, every month when you make that principal and interest payment, part of it is a forced savings account because you're paying the principal. Right? And then if you happen to rent it out and you have somebody that's giving you rent, now you have cash flow, you have them paying down your mortgage, and you get the appreciation and the tax benefits, right? Which nobody told me that at 21. I wish I knew that. But then what Carmela's sharing here is you could have somebody who's like, hey, I can't buy a house for 20 years because of my student loan payments. And then they can never start to build wealth versus, oh my gosh, Carmela's going to show me a way to change my student loan repayments. I can buy a house, start building wealth, and, give it to me instead of the government. So that was my take on it. That's why I wanted to have her on here. So, well, with that, go ahead and have at it.
Cool. Well, thank you. Thank you. Yes, my name is Carmela, and I am a financial planner. I own a financial planning firm. AJ Williams, who is on the call, is one of my partners. Both of us are capable of helping anyone in need of student loan repayment options. Today, I'll be a little bit interactive and I'll share my screen. We can go through some case samples, and if there's something that you want to see, so if you have a grandchild or a nephew that maybe has loans and you want to plug in their income to see what's available to them, we can go through that. I think the biggest thing to take away is just what Jeff said, and I'll reiterate that, is that if we're paying less in student loan repayments, I mean, I'm guilty of that too. If I knew what I did when my husband and I graduated college, we would never have paid as much as we had back. So my husband graduated with over 200,000 in debt on his own. So it's been a long journey, right? And it's part of why I'm so passionate about this. Because I don't think that colleges should be able to put individuals in that position where they're graduating and their student loan payments are 50,000 a year. It is an impossible hole to climb out of. So they don't tell you when you call to set your loan payment what all your options are, because they really don't want to forgive it, right? So we'll go over the basics today, but just know that there's several options available to anyone. We have doctors that are making 300,000 a year that still can qualify for income-driven repayment plans. So today my goal is to just educate you a little bit to hopefully get out there and spread the news that there are some savings that exist. So that, again, I'm just a huge believer in the way that we're all going to benefit. We all have money in the stock market, in our houses, brick and mortar, like Jeff said, is we have to get individuals moving out of their houses quicker. So if you look at the recent census data, it's about 35 is the average age that individuals are moving out of their parents' house. AJ and I happen to share a stepchild together, right? Interesting situation. So I'm sure neither of us hope that he's still living in our home before, at age 35 or beyond. So I think it's just about getting everyone out into the economy to contribute to that and get us healthy again, to, increase the ability to pay back our own debt as a country. So what I'm going to talk about today, and this is an important distinguishing factor, this is in regards to public student loans only. So federal student loans. So students who took Grad Plus loans, FAFSA loans, anything of that nature. If you have someone that has a mixture, right? Maybe they couldn't fund all of their education through government loans and they have outside loans, Sallie Mae, Capital One. That's still something we can help with. It's just a very different strategy. So today, just want to make it clear that this is federal loans that we're talking about. Does anyone understand the difference between a federal loan and a private loan? I guess is where I should start. And I'm interactive, so chime in. I like participation. I always tell my clients, volunteer or you'll be voluntold. So does anyone understand the difference between what I'm saying when I say this is for public loans, not private loans?
I'll tell you right now, I don't.
Okay.
Yep.
Good. So public loans, again, are just those given by the federal government. So it's something that you filled out the FAFSA or the CSS profile for, or you went to an independent school, right? Those are the loans that we're able to get some really creative payment plans set up on. Again, private loans are those not given by our government. So they're those given by lending institutions. Some of the most popular are going to be the ones I threw out. Sallie Mae, Capital One, PNC, Citizens Bank. So again, we can help with those, not to the same capacity, and it's a different strategy. So today is for everyone that's complaining that their student loans just started a month ago. Okay, so everyone who had to start paying a month ago. I'm going to share my screen. And I'm going to go over a lot of information today, and you can feel free to disrupt me. I will preface this by saying this is generalized advice today. So I really, really hope that you yourselves, or maybe you know somebody that could use some help. I'll make sure that you have all of our contact information after today's call. Don't take this and give generalized advice, okay? Every situation is different, and we have to analyze what we expect to happen to that person now and in the future. It will make a huge difference in what option we recommend. So you may not know this. When you graduate college, you have 6 months, right, to find a job and start repaying our federal government. The problem is that they paused payments for about 3.5 years recently, which was a little too long. It felt very permanent to a lot of individuals. So I talked before about some of our clients that are doctors, attorneys, making significant income. It doesn't matter if they make $200,000 a year. If they have not been used to paying a $50,000 student loan payment, it's going to hurt the budget regardless. So anyone can apply for an income-driven repayment plan. So that's the first point I want you to take away from this, is an IDR is an income-driven repayment plan. That means that after you graduate college and you have your 6 months, right, to find your job, you don't just accept the 10-year standard repayment plan. So they'll say there's a 10-year plan, there's an extended plan for 20 years, there's something called a graded plan, which I myself used. So the first term you want to see is you want to ask whoever you're talking to, have you thought about an income-driven repayment plan? There are lots and lots of income-driven repayment plans. And if you haven't logged on to the studentaid.gov website, it is a legitimate website. It's full of so much information, and it's a great place to get started. The SAVE plan is the new one that everyone's talking about. So I guess raise your hand if you've heard anyone say, oh, there's this new plan out. It's called the SAVE plan. I'm going to save so much money. Has anyone heard that?
No.
I don't see any hands. Okay. Well, you should, right? We don't know about it, so we're not utilizing it. So the SAVE plan is definitely the most friendly of any of the plans out there. There used to be a plan called Repay, so REPAYE, just like this, but re on the front. And that used to be the best option. So the SAVE plan, how it works is on an income-driven repayment plan. It depends which one you're in. The government takes the poverty line on your reported family size. So if you have divorced clients that are filing alternate years, that's something we have to be really careful about. But basically, they establish a poverty line based on the number of people in your household, and they give you a multiplier, and that's subtracted from your income. So these are not real numbers. I'm just going to try and do easy math with you. So let's say you know someone that's making $100,000 a year and they're a single person, so the poverty line's 20,000. Immediately, payments are based off of 80,000. Each plan takes a different multiplier. So, the pay plan may take 150%, the SAVE plan may take 215% of that, and anything above that is considered discretionary income. I am just the messenger. So I get excited about this. I get passionate about it because I really want people to be financially healthy. It breaks my heart when I talk to someone and they say, oh, I'm just going to work till, the day I die. I'm going to be working the day of my funeral. And it doesn't have to be that way, no matter what amount of money you make. It's just about getting good habits set up and freeing up cash flow. So the SAVE plan, let's say that, you make 100,000 and your discretionary income, the government says, is 70,000. That's what your payments will be based off of, that level of income. Each of these plans is different. So you can see the SAVE plan will take 10% maximum of what the government determines your discretionary income. The pay plan, which is still in existence, is 10%. But the big distinguishing factor here is that, and I'll go into this when I live demonstrate, The big difference between these two plans is that the pay plan caps your payments. So if you have somebody that's not making much money right now and maybe wants to buy a house, but in the future, you suspect that their income is going to way exceed inflation. You know, they're in the early stages of their career, it may double. We may want to put them on a little bit of a higher monthly payment on the pay plan because they can never pay more than they would have on the standard payment plan. And that's something that'll make more sense when I live demonstrate. Those are the two most common recommendations, is either of those options. There is also an income-based repayment plan. So it's IBR, right? Not IDR. And there's an income contingent repayment plan. Each of them has a different timeline for forgiveness. So that's the whole point of my presentation today, is we want to give them as little as possible, because if everyone else has the ability to pay a smaller amount, you should take advantage of that too. I'm a firm believer in that fact. So with any of these plans, there's a different number of years until forgiveness. So again, tons of information on this website. The SAVE plan is 20 or 25 years of forgiveness. The big distinguishing factor is also on the SAVE plan. If you're married and you're filing separate, so let's say that both you and your spouse have student loan payments, right? And your spouse is a stay-at-home spouse, whether it be a stay-at-home mom or a stay-at-home dad. That individual, if we file correctly, can exclude the other person's income from their required payments. So in theory, it's possible to say that the stay-at-home spouse has a $0 repayment. So I think that's the biggest thing with the SAVE plan, is that if you have someone that's a stay-at-home or makes significantly less money, it's something we need to think about. But again, don't give generalized advice, because then we have to analyze their tax situation and make sure the savings are enough. The pay-as-you-earn plan is 20-year forgiveness. IBR functions much like SAVE, and then income contingent repayment is 25 years. So I'm going to switch over to a live demonstration. Feel free to
what I was going to say is, can we get to the show and tell a portion of this? Because like I need the third grade level, like,
okay,
because what you showed us the last time on the interactive
right here,
the mind-blowing piece, right?
Okay. Yes. So let's assume this person, and I've hid their first name so you can't see them. We can put your student loan data right on in here to help you see it. Let's assume this person has a lot of debt. So this is a dentist. So one of the doctors I was talking to you about. So they graduated with almost 400,000 of debt. So you would think that originally her payment, if we post over here, was expected to be $50,000. Okay. So monthly payment was about $4,000. That's really, really hard. When I met with this client and we saved her money, she actually cried, and so did I, because she said, I never thought I'd be able to have kids and start a family. I thought I made the worst decision. So over here, I'll go ahead and show you the forecasting. So let's just assume that this person makes $60,000. They get a 3% raise every year, and then their income drastically increases, let's say in 2025. I built in that they have 2 children. So this is somebody that owes 400,000 in student loan debt. They make $65,000 this year, and in 2025 they're expected to make 150,000. And then later on in life they're going to have 2 children. When we pop over here, and this is the first grade level that Jeff was talking about, if they're on the standard fixed plan, again, our monthly payment is a little over $4,000. That hurts for anybody. If we jump on over to the SAVE category, which is what we recommended for this individual, do you see right here this number that says 75,000? That means that 25 years from now, this person will have $75,000 forgiven. The SAVE plan pauses your interest, so it's a little more than that, but this is what I like to show clients, and I have to move your heads, I'm sorry. So if they're on the standard repayment plan, they owe about 300,000, right? They're going to pay back 443,000 due to interest charges. If we put them on the SAVE plan, even making $150,000 a year, they will only give the government $218,000. So what you're seeing here in this big red bar, right? This is the 50,000 I was talking about. They're supposed to give the government 50,000. When they called to set up their loan payments, no one told them there was another option. The payment that we were able to get them set up on is an annual payment of less than $3,000. I don't know if you can see that there. So they were supposed to pay $50,000. Now they're only going to pay $3,000 over the course of the entire year, which frees up a ton of cash flow to do things like buy properties, even buy investment properties to start your portfolio. Now, every year you make more money, you may end up paying a little bit more, But look at the final years when they're making almost 250,000 a year. They're still, oh, and this is hard to, they're still
Hover over
only,
that little stick.
yeah, it's so difficult. Let me
That's
see.
okay.
They're
But like,
still
just to say
only
this,
paying 18,000 a year. So
just
I can't get it to stick.
those first 2 years, instead of paying back 50,000, they're paying back 3,000.
Yep, they're paying back 3,000, and even in the third year, their payment only goes up to 11,000 for the whole year. So it's basically less than $1,000 a month. So they were supposed to pay $4,200 a year. The first 2 years, I'll talk about that little trick because that's a good point, Jeff. So when you set up these income-based repayment plans, what they do is they'll go off whatever tax return you filed within the last 2 years. So when I'm working with someone that we always want to tell the government we made less money, we never want to tell them right away that we made more money, is my rule of thumb. So when you get out, if you have kids or grandkids or clients that graduated college and they made no money this year, right? We don't want to file taxes on time this year. We want to apply for what's called an extension because you have to verify your income every August. And you file taxes theoretically in April, but if you file an extension, you don't have to put them in until October. So we can trick the government. So they don't know that we didn't file a new tax return. They just pull in the data from 2 years ago. And that keeps your payments, if you didn't make any money, at zero for 2 years. In her case, she's already been working. So that's why we were able to keep payments so low for 2 years, is because we use the filing and extension tax trick. And that's something I can help you out with. It gets even
Really
better. So,
tricking. I mean, you're just using the rules the way they're written,
mhm,
right? That's the bottom line. Like, it's not like it's manipulative or you're cheating the system. I mean, you're using the rules that are laid out to play with.
yeah, yep.
All the smart elite, I would say it, I'm gonna say it out loud, politicians and all the other people are taking advantage of, but the rest of us out
Yes.
here working W-2s, paying taxes, and taking all the burdens don't know these rules, right? And then
Correct.
we're the ones that are overpaying for everything.
Yes, and to your point, it's completely legal. I file a tax extension every year because I'm so busy helping my clients, right? I can't get it done. If you do it correctly and use somebody to help you, there's no penalty for doing it. You're literally just not reporting to the government that you made more income so that you're able to keep payments low for another year. And if
Right.
we're looking at forgiveness, right? Every dollar we're forced to give them is a dollar that won't be forgiven. So any time that we can make an adjustment to pay less into the system, that's what we should be doing. Anyone who works for a nonprofit or a qualifying agency, so a 501c charity, right? That includes UPMC around here, AHN, they have an even better opportunity. So right here where it said that 75,000 would be forgiven in 25 years, we would have to save $50 a month to pay the taxes. So when this person goes to file their tax return in 2047, they're expected to owe about 15,000 in taxes because this forgiveness is taxable. So we tell them what we have to put into a safe account every month. When we talk about somebody who works for a qualifying agency, it is just amazing what happens. They only have to make 120 on-time payments. They don't have to be consecutive, and they probably make less money working for a nonprofit. So let's say that this individual worked for a nonprofit, and I can toggle that on over here.
Carmela,
So
just to
that,
like help the people in
mhm,
the room, like to help their family and help their friends,
mhm.
right? Instead of like just saying hypothetically, say they do this, that, like what would be a position? Like, would it be a social worker working for a hospital? Would it
Yes.
be like, so if you know a social worker who's working for a hospital, because Tom Hanft, like a couple things, like every time we take applications, right, and you pull up a social worker, like what the situation, like their heart is always in the right place, but what does the financial situation typically look like?
Yeah, I mean, generally, you always have a lot of student loans
Yeah.
using the guideline payments that we have to use, which are,
No.
because they're generally deferred because the person can't pay them right now. You end up having a huge debt ratio issue. So this
Yes.
solves that really quickly and efficiently for them and puts them in a good position.
Because
Yes,
our hearts
but
break because they come in with like $200,000 worth of debt, making like $17 an hour.
Right.
yeah,
And it's like they're never going to be able to buy a house. And then you see something like this, and it's like, okay, they're helping people, right? They're doing where
yes.
their passion, they're doing what their heart is, right? But then there's no financial out for them. And then Tom, the other piece is like, so when Carmela was showing those repayments, right? Like when we calculate debt ratios, can we use what Carmela was shown as the repayment to qualify the customer?
Yeah, once it's official,
Yeah.
And we just get the documentation and we can. So if they're supposed to pay, you know, $2,000 a month and one of those programs is, you know, $200 a month, now we got a lot more room in the debt ratio and they can buy the house that they want instead of being strangled by student loans.
So what I'm saying out loud, and I want to say, like I'm saying it for everyone here, is that when you're talking to your customers and your clients and your friends and your family, especially over Thanksgiving coming up, because you're going to be belly to belly and face to face with a lot of people. One of the first questions you should be saying is, do you have student loans? Right?
Yes.
And they're going to go, yeah. And then here comes the conversation. Well, I need to get you connected, right? Because you may not have to pay as much as you think. And I may be able to put you into a home. And as a real estate agent right now, this is discount season, right? Because everybody's laying up until the spring. And so there's still homes for sale on the market. I know for us, we've picked up the pace. Like Corey Beadle has thrown a ton of contracts into the pipeline over the past 2 weeks. And because we're not going to sleep, we're not resting right now. Like we're working harder now than we have all year long, because this is the time that people can get deals. And if you can use what Carmela's sharing with us today, you'll create a market for yourself, right? Like when I hear people go, oh, the market's low, it's no good, you know, I can't get any business. Like you can create your own business, right? And I just want to, I'm trying to clap my hands and stomp my feet on this one, because this is a big deal. And it just starts with a simple conversation of, do you have student loans? And then here comes the conversation.
And if they have been working, it doesn't have to be a social worker. It could be a doctor for UPMC. I sit on the board of a charity called Fix Your Cat in Canonsburg. Anyone working there would qualify. But the point is that if Tom just said, you know, they can't afford to make payments, so they haven't been making them. If they just verify their income and sign up for a plan, all of those years count. So if you have a $0 payment because you can't afford it, if we just hop on for 10 minutes and verify your income, all those 3.5 years that you weren't required to make payments count towards your forgiveness, which is something they are also not telling you. So everybody theoretically got 3.5 years of free payments, where we could have paid 0 and it counted as on-time payments. So in this example, someone's at, you know, $300,000, $400,000 in debt. Their payment goes down to almost 0. If they work for a public 501c, they would give the government over the course of 9 years $72,000, and they would have tax-free $315,000 of debt forgiven. So I think these are the things, to Jeff's point, you can make your own business. And it's also just about being a good person, getting out there and saying, do you need help? Do you have student loans? Did you know these crazy programs exist that can help you out? Anyone working for a 501c will have more favorable treatment, but the end point is everyone qualifies for an income plan. I just don't know which one to put you on until I talk to you.
That's good. That's good.
Does anyone have any questions? Because I know that was a mouthful and it's tons of information.
I actually do, but I don't want to take up everybody's time, because this is in relation to my daughter who just got out of school and now owes back her student loans, and she works at Giant Eagle, and they want her to pay like $700 a month. So I would love to talk with you to see what her options are.
Perfect.
Yeah.
Yep.
We'll provide Carmela's contact information whenever we send out the replay of this video,
Okay.
so that you'll have it there for you. But Carmela, if you want to drop it, or if AJ wants to drop it in the chat, so somebody, you know, so Denise can grab it now.
Yeah, let me.
Yeah.
Oh, I think I had a question. So I'm going to type my phone number in here for everyone. My cell phone is 724-263-1819. And my email is just my name, Carmela Pham, at financialguide.com. And I had to make sure I spelled that right. So it's in the chat. I'm really easy to get a hold of. If you can't reach me, you can always reach AJ. He's a great resource as well. But really, it's just about having time to sit down and get to know you. It's 4 steps to upload your student loan file, and it's a raw file that'll look just like this for me so that I can see everything about you. And then we'll just have a quick meeting and see if we can help you. I really think that most people qualify for these programs and just don't know it. So if your daughter's working at Giant Eagle and they're expecting her to pay $700 a month, there's opportunities that we can take to help her out.
Bingo. Like that's powerful right there, right? Like that's, yeah. Impact.
Does that include if does that include if we took out the parent, whatever loan that's called, that parent?
The Parent Plus.
Parent Plus. Thank you, Jeff.
I have some bad news with that, and come see me if you have a Parent Plus loan. The Parent Plus loan is something that I advise all of my clients. It should literally only be a last resort. There's origination fees, there's high interest rates, it follows you forever. The only escape is death. There's things we can do to help you out with that, but unfortunately, Parent Plus loans do not qualify for a program like this. Only loans taken out directly by the student. So any Stafford loans, any Grad Plus loans, anything of that nature would help. And a lot of you have, this is the perfect season talking about creating your own business. I can shoot names over. We have, my group works a lot with nurse anesthetists, and they are graduating. They've just graduated in the last month. So they've all taken their boards and now they're starting employment. Every single one of them is looking for a property because they have unique opportunities. And this is something Jeff would know more about with the physician loan, no down payment. But they're all looking for opportunities to get houses right now, even in a crazy market, because they're happy. They were broke. They're 35 years old. They've been in school all their lives, and now they're making crazy money. The first thing they want to do is get themselves set up in a house. So if you need ideas with how to reach out to doctors, nurse anesthetists, anyone in the medical field right now that's very pertinent to them, they work on a different graduation schedule.
Yeah, because most of the doctors, it's like in March that they get their assignment. What's the name of that? It's their something day.
It's
their when they get, what is it?
Match day.
Match day. Yeah. Yep. Thank you, Corey.
And I'll share this really quickly. I just wanted to hop off so you didn't see all the other clients, but it's not just for people that have like a crazy amount of loans. So this individual, they owed $48,000. That might be more in line with someone you're working with. I put in that they made $40,000 a year. So when you see this option, if we jump over to save, they're supposed to, at $40,000 a year, pay $6,200 back over the course of the year. So let's do easy math, $500 a month. But when you're making $40,000 before taxes, right, and all your other expenses come out, these are the types of clients you should be searching for that don't think they can afford a house, let alone a family. Look what happened. We were able to get them $0 payments, okay? So over the course of this, they paid back a lot less money. And we'll analyze each plan, but for them to give $28,000 back instead of $54,000, and actually this is wrong because I have to take out them making more money. So let's assume they make $40,000 and get a 3% raise. These numbers are going to look even better. So they technically, look at this, have $0 payments for the entire 10 years, and then it's forgiven. If we put this on a regular payment plan instead of a public student loan forgiveness, they would probably have $0 payments all the way up until their last couple years. So this person literally gave the government $0, and they would have given them $55,000. So it's not just for people that owe an exorbitant amount of money. It's for anyone.
And so the one rule of thumb I remember you telling me was if their student loan is double their annual salary, that's a good, right? That's
a good thing. Yep. That's my general rule of thumb. Now, if they have like 3 kids, right, that's a different story because we have more to work with on the poverty line. But the first question to your point, you should ask someone over Thanksgiving is yes. If you have $50,000 in loans, as long as you don't make over $100,000 consistently every year as a single filer, there's probably some forgiveness that we can help you with. And that's a very general rule of thumb, but yeah, I think it's a great conversation point.
Yeah, that's so good. Freeing up that much money on the debt ratio. Like I've watched Tom Hanks close loans by a clock, not even financials. Like it had to close before noon. You give him this much room, he's getting everybody at home. Like he's getting everybody a home loan. I'm telling you. That's why I'm excited about it. So this is so good.
And we can share the reports with your agency if they're a joint client. We can just send them out. The process honestly takes about 6 minutes if they share their screen with me or meet me in person to actually sign up for the relief program. And you do have the option to pause all of your payments. So Denise, if your daughter's expected to pay $700, we can just say, hey, don't take any money out of my bank account till we get on the new program. So that's something that's available to everyone. And honestly, the process, probably the consultation to figure out what to put your client in takes about 20 minutes. So half hour total, we can get them set up on some payment plans.
So good. So good. Thank you so much.
You're welcome.
We always brag about a half hour in and out with no sizzle, all substance, and we did it. Like, because I started 5 minutes late, so it's 30 minutes. Any questions for anybody? Everybody good? Was this helpful? Like, am I crazy? Should I have been this excited about this?
No, that was super helpful. And Carmela, I will be reaching out to you.
Perfect. Yeah, absolutely. Have anyone reach out to me. I'll make sure I give Jeff some cards too. They can call, they can text. We own our own business, so we work around the clock, just like all of you. And really just being able to help people is the biggest thing that we can give back, because again, I know AJ feels the same way. He paid off his student loans and regrets it every day. I'm on a track where we're stuck on them now. So yeah, the quicker I get my hands on you, the more I can help, is what I'll say.
Yeah. And I promise I wasn't always this old, like getting excited about this kind of stuff. AJ, I used to get excited about cooler stuff when I was younger, right?
Yeah, you were a lot cooler about 10 years ago, man.
I know.
Carmela,
Thank you.
when do we
Yes.
need to like reach out to you? Like, do they have to be finished with their school, or could they be in the first year or second year?
Yeah, if they're in the first year and second year, I'd love to talk to them, because I want to make sure they're borrowing the correct way. And I want to make sure they're doing it in a way that we can work with them after. So like if you have anyone in school and they're being offered higher loans than they're accepting, that's a scenario where we'll actually crunch the numbers. And if they're open for forgiveness, it's like a tax benefit of free money. So as soon as I can get their hands on them, the better. We even help with the college loan or college planning. So, you know, if you have people that are in junior high, high school, my team will walk you through creating a college list, negotiating offers, because nobody, even millionaires, should be paying full price for college to begin with. So as long as you're applying to a list of credible offers, you can actually negotiate and appeal those. So we're in that season right now. We're really busy with it, but we also help on the front end to try and avoid you taking out so much debt as well.
That's awesome. Thank you.
You're welcome.
No good. Thank you.
Thank you. And if anyone has any questions, like I said, on pre or post college, there's no such thing as a silly question. And we hope to talk to all of you soon.
So good. Have a good day, everyone. If you need anything, we're here for you.